Hey everyone, Richard Norris here, and in today's video I'm going to talk about mastering the art of scaling a small property portfolio, and I'm going to be sharing with you some key insights into how myself and my clients have been able to scale our property portfolios to make them extremely profitable, get really high return on our investment, and make them safe at the same time so that they're recession proof and can basically last the test of time. So with that being said, if you're new to my channel, please make sure that you go ahead and subscribe so that you can follow my videos for more property content and updates. Please make sure you go ahead and click that like button and also click the bell icon so that you can be notified of any new content that I'll be releasing on a weekly basis. Now, for those of you who are new to my property channel, my name is Richard Norris. I'm the founder and the CEO of a company called propertyconsulting.io. And we help people to start and scale property portfolios. So with that being said, let's jump right into the video. And I'm going to share with you, like I said, the key insights in how to scale a property portfolio. So this is really going to be very useful for you if you're somebody who's got anywhere between 1 to 20 properties and you're looking to scale the portfolio, but you're unsure in how to go about it. What's the best approach? What's the best method? And what ways can you scale a property portfolio for optimization? So the first thing that you need to really be thinking about when you've got a property portfolio is you need to basically assess the state of your current property portfolio, okay? So you want to think about what are the current returns that you have in the property portfolio, what return on equity are you getting in the portfolio, because we really want to establish how hard your money is working for you. Because at the end of the day, when we're investing in a property portfolio, we're obviously looking to build long-term wealth for ourselves and potentially our families in the future. Now, it's all about making sure that the money that we've invested is working as hard as it possibly can so that we can maximize growth and, of course, at the end of the day, maximize cash flow and profitability from the property investments. Now, when you're looking at and assessing the current state of your property portfolios, there's some things that you need to consider. Not only do you need to consider the key aspects of returns on the investment, like I've just said, you need to be thinking about what is it that you're trying to achieve for long-term growth. Now, that will be unique to everybody. So everybody that I work with, every high-ticket client that I work with in our flagship training program called Quantum Property, they all have a bespoke, unique set of circumstances that are unique to them, the goals and aspirations that they have, and obviously everybody's got different family circumstances, income brackets, etc. So therefore it's really important that you take that into consideration as you watch this video today. So the first thing you need to do, like I said, is you want to really assess the state of your current property portfolio. What are the key considerations that you need to think about first and foremost? So the very first thing you need to take a look at is you need to start mapping out the number of properties that you have, and you need to break down each property into its individual metrics. So one of the things that we do is we start to look at what is the value of the property, what is the existing debt on the property, therefore what's the loan to value on that property? Is it 50%, 60%, 75%? What does that look like? And we're starting to look for one of the key performance indicators which we look for, which is how much equity is in the property in its first instance to see if there's any margin to scale. Now, the very first thing you need to be thinking of is just because that there's equity in a property, it doesn't mean that you can refinance the asset to scale the property portfolio, okay? Because you might refinance that asset and you find when you take the interest only mortgage up from say 50% loan to value and you increase the loan to value to 75% to release some equity, in doing so, if the interest rate at today makes the investment profitable, so it's still cash flowing, i.e. your rent minus your mortgage still gives you profit, if you increase the loan to value from 50 to 75%, but you see at 7 or 10% interest rates, it falls into negative cash flow, then that's going to be a problem, okay? So the first thing you need to be thinking about is what is the state of your current property portfolio in terms of the individual property? How much equity is in each property? What is the current interest that you're paying on each loan in the property portfolio? And then what you need to do is break that down into what is the interest costing me today? Am I on a 3% loan, 4% loan, 5% loan, right? What does that look like? And then if the interest rate on that loan went up to 7% or 10%, what would that do to your cash flow? Now, fundamentally, that's the very first thing that I see when I'm working with my high net worth clients and anyone who wants to scale their property portfolio. They don't have the finger on the pulse to their finances. They might know what the cash flow is today, but they haven't looked at future stress testing. So they've not looked at any of the debt coverage ratios, which is what the banks look at. And the banks look at 125% or 145%, depending on a 2-year or a 5-year fixed term. And they'll basically run that against a 5%, 6%, or a 7% interest rate. And the clients that I typically work with, they know, like I said, what the interest rate is that they're paying today. They have a clear snapshot of what the property is performing like today, but they don't understand if the interest rates on their current loan were to go to, say, 7% or 10%, they don't know the implications of that. Now, if they have tracked that, one of the things that you need to consider is if you're just looking at the individual properties on their own, it's not going to give you a holistic global picture of the whole profit and loss statement, and therefore you're not going to be able to basically analyze the whole performance of all of your properties. So the first thing I get you to do, and the first thing that I recommend that you do, is you create a clear picture of all of your properties. So you look at the individual metrics of the property, and then you basically look at the holistic view, and you break that into sort of one system, and you can basically analyze all of the properties together so that you can work out cumulatively on all of the loans that you have on your properties at 5, 7, and 10%, what the interest rates would go up to, what would the cost of your new mortgages be at the different variances in mortgage interest rates, and what would that do to the cash flow and ultimately the profitability of each property and the whole portfolio as a whole. So that's the first thing you need to do. You need to understand what that looks like, okay? And you need to understand what is your equity position. What I tend you to look at is what is the annual cash flow from your property? And then I get you to look at, and I divide that by the equity in the property so that we can get something called our return on equity. Now, when you understand the level of returns on your equity in the portfolio, you can assess how hard is the capital inside the portfolio working for you. It doesn't give you a true reflection of your return on capital invested, which is the most important metric that we look at on new acquisitions as property investors. But because we're looking at scaling an existing property portfolio, we need to understand what your return on equity is. And that actually is going to be honest, the most fundamental and the most paramount thing that you look at first, okay? Now, the next thing you need to look at is you need to be thinking about your tax structure, okay? So you need to be thinking about, okay, what nuances do I have in terms of tax? Is my property portfolio in the right tax vehicle? Now, I'm going to be brutally honest with this. Every single client that I've ever worked with who's come to me and asked me to help them to scale their existing property portfolio, everyone has had it in the wrong tax vehicle. Most people don't have a family investment company set up, or what we call a smart company share structure, which shields them from inheritance tax. And they've basically brought the properties either in their own personal name, and they've built up a Section 24 tax liability, i.e. they're paying too much tax as a high rate payer in the UK. If you've got property portfolio in the UK as a high rate taxpayer, you're going to be subject to Section 24 finance restrictions, which basically meant that you cannot offset any of your mortgage interest relief, and you get kind of a reducer of 20% of the total annual mortgage costs at the end of the calculation. But without me going into the granular depths of what Section 24 is, there's another video on my channel that explains exactly the implications of Section 24. But if you're somebody who's got properties in your own personal name, you're definitely going to have an inheritance tax problem, and you're definitely going to be subject to Section 24 finance restrictions, which means that you're going to be paying more tax than fundamentally that you should be. Okay, so they're the first considerations to look at. Okay, have I got my properties in the right tax vehicle? Again, if you haven't got them in the right company setup, you're going to have a capital gains tax problem. For high rate taxpayers, that's 28%. And even if you're somebody watching this video and you're a lower rate taxpayer, right? Well, you're still going to have like future tax problems. So maybe your capital gains tax bill is only 18%, and maybe you're only paying basic rate tax at 20% on the income in your property portfolio, and maybe you're still under the inheritance tax threshold, so you're using your nil rate allowance of £325,000 per person on the property portfolio. And maybe you're thinking, well, I have got the properties in my own name, but I'm a lower rate taxpayer, so I don't have these nuances yet. Well, the key thing is yet. If you're looking to scale the property portfolio, at some point you will crystallize these tax problems. So it's really important that you have your properties in the right tax structure before you scale. So one of the things that we look at with our clients is it in the right tax structure? What tax nuances do you have? And you need to get really clear on the exact amount of problem that you have. So let's say, for example, you've got an inheritance tax problem. You need to know exactly, have I got a £300,000 inheritance tax liability today, £1 million inheritance tax liability today? What does that fundamentally look like? How much tax am I paying on my properties? And how much tax am I losing because of Section 24 if you're somebody who's basically subject to that because you're a high rate taxpayer? And at the same time, if I were to sell any of these assets based on the growth in my portfolio over the years that I've had them, what is my capital gains tax position? You need to break that down into a numerical value to understand what is the size of your problem and how best to deal with that. Okay, because the only way that you can truly scale a property portfolio and make it extremely profitable is to look at the numerical data and make decisions on data and not emotions. Okay, even if you're somebody who has properties in a limited company, you might be thinking, well, I'm a high rate taxpayer, I own properties in limited companies, so I don't have section 24. And I would agree with you, but most of my clients, actually, again, I'm going to say it, all of my clients who have been in that situation as a high rate taxpayer and have invested through a normal limited company have created inheritance tax problems, because without the right share structure, maybe a discretionary trust with growth shares to shield all of the existing capital growth in the portfolio from inheritance tax, you're basically building an inheritance tax grave, is the truth. You're basically adding problems at scale when actually we should be investing and things should be getting better at scale, not worse. Okay, and many of our clients don't realize that if they invest in a normal limited company structure that they're creating these inheritance tax problems. Okay, so there's one of the things that you need to think about as well. Am I in the right share structure? Have I thought about this correctly, where all of my subjective parameters have been shielded by good tax planning? Okay, so that's something to look at as well before you to start to scale. Now, the next thing that you need to think about in the portfolio is, like I said, and like I alluded to a little bit earlier, is all about what is the position of your portfolio today, and takes into consideration a set of numerical value based on rising interest rates at 5%, 7%, and 10%. Now, when you're assessing the property portfolio, one of the biggest problems that I see that investors have is they come to me, and if they've got properties that are owned in the southeast, let's say Oxford, London, anywhere around those sorts of areas, anything really south of Coventry on the map in the UK, you might get higher capital growth than you would generally in the north of the UK. As a generalist comment, doesn't always hold true. But let's say that that does hold true, and we're talking generalist here. And, you know, typically speaking, if you're south of Coventry, you're going to get capital growth. Your yields on your property investments are going to be lower. You're definitely going to have problems at scale. And so one of the initial problems, without even looking at your property portfolio, that you're going to have is if you've got debt on the property as well. Okay, it depends on the loan to value. But one of the usual problems that we see in nuances in that scenario is if you run your stress test on your properties, assuming that these are just normal buy-to-let properties, okay? They're like a 1-bed, 2-bed, maybe just a normal family home that you're renting out to one set of occupants. So it's not HMO or anything like that. Your yield in those areas is going to be between 3 and 5% max. Well, if interest rates go to 6, 7, 8, 9, or 10%, you can see that's higher than the gross yield of your property. You're going to see that you're going to negatively cash flow at that position. So therefore that becomes a point of interest, it becomes a nuance, it becomes a weakness in the portfolio. And when you're looking to scale out, you're looking to scale that problem out of the property portfolio. And you might be asking, well, how do I scale that problem out of the portfolio? And there's a couple of things you can do, which I'm going to allude to in a second, okay? But most of the time in those positions, what you'll have, if you have that problem as well, is you'll have a low return on capital employed, okay? So if you're somebody who doesn't have the problem of at 5, 7, and 10%, if you see the negative cash flow, the only way if you're investing in the southeast where that would hold true is if your loan to value is low on the property. So typically speaking, as a general rule of thumb, if you've got anything less than 40 to 50% loan to value on your property, then you may be okay at those 7 and 10%, but it's still not going to be great. You can't force the yield above sort of 3 to 5% in those areas, okay, when you're investing in the southeast. So that's one of the problems we see, and that's a consideration. And if you are in that position where you've offset that risk because you've basically said, well, I'll reduce the loan to value on my property portfolio, that's great. You take your loan to value down to 30%, but now you create a problem because you can't scale. You've got 70% of your cash tied up in that property, 30% as debt, 70% of equity. Your return on capital employed is going to be very, very low. So your money's not working very hard for you. So we need to think about, well, how do we get hold of that capital, scale the property portfolio, and at the same time be okay if the parameters, when we put the new loan on the property, increase the loan to value up. When we see things go from, say, 5% as positive cash flow, at 7% and 10%, we now make negative cash flow because the cost of our mortgage has gone up. We need to think about how to offset that at scale and how is that okay. Okay, and there's some of the things that we look at with this whole spreadsheet and kind of a dashboard with all metrics and numerical value that tracks these decisions that we have to make as we scale to help us do it safely, diligently, carefully, at the same time maximizing growth and keeping things responsible and inside the safe key parameters that we track. The only way that you can really basically scale that out is through diversification. Okay, so you need to think about, based on your own individual parameters, how can I scale this property portfolio diversify my investments into new asset class, i.e. by what I mean by new asset class is you're going from buy-to-let properties to HMOs or commercial to residentials to force the yield up, okay? So whilst I'm on that topic, let's talk about that. What strategies do you have for scaling up a property portfolio? Well, some of the strategies that you have for scaling up a property portfolio is to increase the loan to value, like I talked about. So if you've got a 30, 40 or 50%, you've got some equity, right? You can the maximum that you can borrow up to with a mortgage lender is 75% of the asset, assuming that all of your debt coverage ratio stays inside the key parameters at 125% on a 2-year fixed loan and 145% on a 5-year fixed loan as of today in 2023. At the time of recording this video, they're the parameters that the banks will look at. And they elect to say, we'll allow you to increase the loan to value on this property and reduce some equity through refinancing. Okay, so that's one of the things you can do. You can look to refinance your assets, increase the loan to value, take the equity out, and then look to buy new properties with the capital that you've released from those properties. Okay, the next thing that you can do is to diversify your asset class, okay? So let's say that you've got buy-to-let properties, and typically we see this, like I said earlier in the video, like I alluded to, the biggest problem that we see for any property investor when they come to us, if they've got a problem at 5, 7 or 10% interest rates, is that, like I'll give you an example of a client. A client came to see me, they had 12 properties owned in their personal name. First problem is it's in the wrong tax structure. They were a high rate taxpayer. They'd created £1 million of inheritance tax problems. And because they're in London, they've obviously experienced huge capital growth over the years. And therefore, they've got a capital gains tax problem as well at 28%. But the biggest problem with these people is even though the loan to value is low on the property portfolio, in this scenario, it was about 55% loan to value. Because the asset class in the investment strategy was all just single lets, or just buy-to-let properties, what we saw is it was very profitable today. So the property portfolio made around £120,000 of gross profit before tax, okay? And then the issue is when we ran the metrics at 55% loan to value on the current debt on the portfolio at 7 and 10%, more importantly at 10% interest rates when we hit recession, this client was going to go bankrupt because he went from £120,000 of profitability a year to losing £120,000 a year because the cost of the mortgages went up from, say, 3.5%, 4% to 10%. Now that 6% addition on a property portfolio that only has a yield between 3 and 5% will make you see those big losses at scale if interest rates were to rise. So that's a risk. Now you need to diversify that risk out. So if you're looking to scale the property portfolio, in that scenario, you need to find properties that you can leverage against, release the equity, and then buy new investments to offset that 10% risk. Now, obviously, you could sell some of the assets, for example. You could dispose of some of the assets and crystallize the capital gains tax hit. There's a far better way, providing that you can incorporate your properties and you've spoken to an expert tax consultant and the appropriate lawyers and barristers to make sure that you're incorporating properly and safely. That's key and fundamental to that. You would incorporate the properties and then you would sell the properties so that you don't pay the capital gains tax, and you can defer that through doing a capital share exchange on the day of incorporation so that the value of your capital sits in the shares. So you actually don't pay the capital gains tax bill when you sell the assets, okay? So that's one of the things we suggest to our clients. If you're going to sell the property, get the cash out, reinvest it into more profitable investments, then you want to incorporate first, typically speaking, so that you can basically make those or defer those capital gains tax, because you're not really saving the capital gains tax. You'll pay it at some point, but you'll exchange that for shares, which is far more tax efficient. However, without going into too much detail about that, we'll move on to diversifying the assets. So one of the things you can do to offset the risk, if you've got a buy-to-let property portfolio, is diversify into investments that are like HMOs, where you can really force the yield up, or to do commercial to residential. Typically speaking, we see the path of least resistance, the most obvious thing and easiest thing to do when a client comes to us with an existing property portfolio of buy-to-lets with equity in, is to release the equity and look for new investments where you're going to get 20 to 25% return on investment by investing in areas which are north of Coventry. So maybe Manchester, Liverpool, Salford, Eccles, Warrington, St Helens, any place around there, branching into areas like Middlesbrough, for example, anything around the northwest that would give you a higher yield. And Leeds as well is a good area where you can get a much higher yield, sort of 7, 8, 9, 10. Usually in an HMO area, in the right area, you can scale your gross yield to 10% plus. And what that is going to allow you to do is it really allows you to offset the risk at 10%. Because when you can force the yield up above 10%, when you run your metrics on that individual set of circumstances on the HMO in that example, you'll see that your profit, even at 75% loan to value on the right assets, even at 10% interest rates, will be profitable. So that will make up for the losses at 10% on the other investments, which are the single lets. And over the course of building that over time and buying a series of property investments that become profitable at 10%, you offset the losses on the other properties at 10% to bring it to cost neutral. And ultimately in the future, what you want to see is you want to see your debt coverage at 10%, 125% plus, which would mean that you're still seeing profit at 10% across the portfolio. Now that is achievable. Even I've got clients that have invested in the Northwest, in Wales, for example, where they can force those yields up above 10%. Even at 75% loan to value with a 20% return on initial capital investment, they are still profitable at 10% interest rate. So that's one of the ways that you can scale, is through refinancing and diversifying into a new investment strategy from single lets to commercial to residential or HMOs, as I've alluded to there. Okay, so the next thing that you might be thinking about is, how do I go about evaluating new properties to add to the property portfolio when I'm looking to scale? Well, this goes back to one of the first things I said earlier in the video, which was talking about what are your goals? What are you trying to achieve? And from what I know, most people that I work with, they're trying to achieve cash flow. They want to achieve good cash flow within the property portfolio as opposed to seeing long-term capital growth. However, if you were looking at this from sort of an ideal position, most people would say that I want cash flow plus capital growth. So one of the things you need to do is evaluate what is your growth potential based on your own individual parameters and goals. So for some people, that might be scaling up and looking at properties for cash flow and capital growth, and for others it will just be cash flow. Now in the early stages, when you're trying to scale your property portfolio, I highly recommend, I do this with my own portfolio, I highly recommend that you focus on cash flow as the primary objective, because you cannot scale a property portfolio without cash flow. You need to create that compound effect, and the only way to create that compound effect, to build in hyper growth into the scaling of your property portfolio, is to buy assets that are going to give you maximum cash flow and maximum return on your investment. Otherwise, you're always relying on the market for long-term appreciation, and it can take years to get enough appreciation to then refinance the asset to grow again. Okay. One of the other things that you can do is you can look at new potential. Okay. So not just capital growth, but you can look for evaluating properties that you can add to the property portfolio using a buy, refurbish, refinance strategy. And that's probably going to be the best thing that's going to move the needle. And the reason that this is going to move the needle in the quickest possible time frame is because you can add value to those assets. Okay. So when you're doing a buy, refurbish, refinance model, what you typically do is you're going to be looking for properties where you can add value. Now, that might be a property which is dilapidated, which needs refurbishment or renovation, or more importantly, in my opinion, the best thing that you can do is look for properties which are prime for conversion. So you might look for a 3-bed property that you can convert into a 6 or 7 bedroom HMO. Okay, and that would be a strategy that we use to diversify our asset classes and to increase the return on investments in our portfolio, across the portfolio, offsetting those risks at 10% interest rate to bring things into positive cash flow at 10%, even if we were highly geared across the portfolio. Remember, it's all about keeping things safe and responsible at scale. Most people make the mistake that they think, well, if I scale my property portfolio up to maximum leverage, 75%, then I'm being risky. But I can fundamentally tell you through data and the system I've created that you can have a low loan to value property portfolio at 30 to 40% in London, which will be more risky than a highly geared property portfolio at 75%, making higher returns in the northwest of the UK. And it's because there's a number of variables that need to be considered. And actually, the numbers, when you run the algorithm in property and you do all the numbers, what you'll realize is that the numbers aren't linear. And actually, it's the way that you compute, the way that you think about the numbers in a linear fashion, lower loan to value, safer, lower returns, versus higher loan to value, higher returns, more risky, doesn't actually compute when you run the algorithm and run the math, because it's not linear, it's asymmetric. Okay, without going into too much about how the math works with that and how to keep things safe on a numerical and track the numerical data, the key is to buy properties and explore buying properties that have the potential to add value to. Okay, so something that you could maybe thinking about, can I add a loft conversion under permitted development rights? Can I put a single story extension under permitted development rights? It doesn't need planning permission, right? Am I able to take a 3-bed to a 6-bed where I can again do it under permitted development rights and I don't need to apply for planning permission? These are all simple techniques, and the easiest techniques when you're starting out to scale the property portfolio because you have less red tape, less barriers to entry. What I mean by that is like going through planning permission can be timely, can be costly, and can cause delays when you're looking to scale the property portfolio at the beginning, in the early days. Okay, so they're the types of properties that you want to be looking at. What properties can I find that are going to give me a return on investment of 20 to 25%, where I can add value, refinance the asset once I've done the conversion works? And typically speaking, my own personal parameters are, for every HMO that I do in the Northwest, typically these days I want to leave about 40 to 50,000 pounds of cash in for about 1,000 to 1,500 of net cash flow back, and I'll achieve that 1,000 to 1,500 net cash flow with 40 to 50k of capital left in via the buy refurbishment refinance model. From creating a 3-bed into a 6 or 7-bed HMO, I would achieve similar metrics to that. So that's one of the ways that you can look to evaluate properties and find properties that are going to enable a great diversification strategy for you to increase the returns, optimize the cash flow, and at the same time scale the property portfolio responsibly and hit your income goals. Okay. The next thing I want to speak about is the different financing options that you have available to yourself when scaling a property portfolio. And I'm not going to go into the granular details here because I'm going to create another video on my YouTube channel all about these individual finance options. And I'm going to talk about each one individually. Okay. So some of the ways that you can scale a property portfolio using a buy refurbishment refinance model over a traditional model where you're just putting down 25% deposit, because you'll be there forever, to be honest, saving deposits, putting them down, waiting for capital growth to then refinance. It's not a strategy I recommend. So what creative financing strategies that would allow us to do a buy refurbish refinance model when scaling a property portfolio up are bridging finance. So you can use a bridging loan. This is unregulated finance, which is great. It allows you to buy properties at speed. You can use third-party angel investment money. So often, a lot of the time, I raise private equity alongside my own personal cash with the bridging lender, where I can basically add value to those properties using my own money, the bridging loan, and a private investor. They don't mind. Whereas if you go down the mortgage route, which we call mortgage in, mortgage out, bridge in, bridge out. Okay, so when we're talking about bridge in, bridge out, or mortgage in, mortgage out, so talking about buying a property using an acquisition structure of a bridging loan on the way in or a mortgage on the way in to fund the acquisition, and then we're going to add the value, renovate, and then we're going to refinance out onto a mortgage all of the time. So that's what bridge in, mortgage out, or mortgage in, mortgage out means in my rhetoric there. Okay, so there are a couple of financing options that you have. Okay, now my point was, if you're looking to raise private equity, so private finance from individuals to maybe borrow the money for refurbishment or borrow the money towards the deposit contribution, you would have to go down the bridging loan route because mortgage lenders are FCA regulated, and you cannot borrow more than £25,000 of a gifted deposit from a family member. Okay, if you wanted to, one of the other things that you can do is you can go to a bridging lender and effectively take on one of their development loans, okay, a development loan product. That would allow you basically typical terms for a bridging loan. You put 25% of the deposit down on the purchase price, you put 75% on the bridging loan, and then the bridging loan lender on their development loan facility will give you 100% of the refurbishment costs against the gross development value, i.e. what is the asset that you think it's going to be worth after you've done the renovation and the conversion works to refinance the loan plus the development finance and pay them back. Okay, so there are a couple of finance strategies that we use. Another finance strategy is you could use your own cash, so we call it cash in, mortgage out. So if you're in that position, some of my high net worth clients are, I do this today as well. I buy properties for cash using my own money, and then I'll refinance out onto a mortgage. The other way that you can do it is you can basically do a cash purchase, but you can raise 100% of the capital from investors, or you can raise some of the capital from investors, combine that with your own money and do a cash in, mortgage out deal as well. So there's a few funding options there for you. The other thing that we see a lot of our clients use, and what we help our clients with, is to get them to use a SAS pension. So we might convert their own pensions into a SAS pension, and you can basically do loan back facilities and use the SAS pension to buy residential property. Even though a lot of people will tell you can't buy residential property with a SAS pension, you can. There's a certain way that you do it through a complex process of lasting power of attorneys and stuff, but you would use a loan back facility as well. So you can basically use your SAS as an investor to your property company. You can lend the money from your SAS company to your property limited company, either to buy the asset or to refurbish the asset. The only thing you need to consider is it would have to be a cash purchase with the SAS pension, and the SAS pension provider would need to take a first legal charge. So you can't mix mortgage lending with SAS lending, because both of those lenders will want a first legal charge, and you can see why that wouldn't work in both of those scenarios. Okay, so you could use a SAS pension and do a loan back. So there's some of the options that you have available for financing and scaling up the property portfolio. The other thing you can do, which we see a lot, and I do in my own portfolio, is you can raise private finance from third-party investors, friends, family, or just high net worth individuals, or anyone who's got cash that wants to do business with you, you could basically borrow money for them and leverage against your portfolio. So if you've got an existing property portfolio that's profitable with good equity in, what you can do to make sure you don't basically prohibit your mortgage terms and conditions is you can put a floating charge against the portfolio. Or if you've got an asset which, let's say for example, is owned cash and there's no mortgage on it, you could basically raise third-party finance from a private investor and give them a first legal charge over one asset in the portfolio or a second legal charge. And if you couldn't get a second legal charge because you've got a mortgage on it, you can use something called a declaration of trust. So again, like I said, if you don't understand all of these terms that I'm talking about in the video, don't worry. I'm going to be creating separate videos on all of these things on my YouTube channel so that you can build your knowledge base and explore my channel to go into the depths of what is a declaration of trust, how you use them, and all of those things. And actually, inside our main training programs and training portals, we have all of the videos and a plethora of the videos with abundance that goes into the granular depths of all of these different things. Okay, so there's some of the financing options that you can use. Now, lastly, just to wrap this video up, then to conclude, when you're scaling a property portfolio, I just want to share with you a client case study that we've done recently. So we had a client. They came to us with 4 buy-to-let properties in and around the London area. Average loan to value was around the 60% mark, and it was return on equity was around 2 or 3%. They were making about £30,000 a year of net profit, but they had problems at 7 and 10% interest rates at scale if they were to increase the loan to values on the property portfolio. And we helped them to go from 4 properties that was owned in the wrong tax structure. They were owned in their personal name. They were a high rate taxpayer, Section 24 implications, big inheritance tax bills, big capital gains tax problems. And we helped them to set up new tax structures that were much more tax efficient to help solve some of the nuances of the inheritance tax, Section 24 finance restrictions, and capital gains tax. And within 12 months, we've added an additional 8 properties to the portfolio. So we've taken them from 4 properties to 12 properties, increased the return in the portfolio, managed to diversify out all of the risk in the portfolio at 7 and 10% by diversifying from single lets into HMOs and investing in Peterborough actually and Leeds as 2 investment strategies, using co-living as the model, doing 3-bed to 6-7-bed HMO conversions, and at the same time creating a very tax efficient structure for them to do that. Okay, so hopefully you enjoyed this video. Hopefully you liked it. If you did like it, please go ahead and hit that like button. Give us a thumbs up. We'd really appreciate it. If you haven't already, make sure you go and subscribe to the channel so you can follow my work for more property content and updates. And also make sure that you click that bell icon so you can be notified of any new updates that come out, because I record videos on a weekly basis to try and help you and give as much value as I possibly can so that you can go out there, become financially independent, grow your property portfolio. And last but not least, if you enjoyed this video and you've got a property portfolio, an existing property portfolio, and you'd like myself or my team to take a look at it, then please just comment in the comment sections down below. Just put yes, and then if you feel comfortable, please put your email address, and then I'll get my team to go in and we'll email you specifically about your scenario. We'll give you an opportunity to take a look at your existing property portfolio and give you some insights into what we would personally recommend that you did to scale your property portfolio. So if you're interested in receiving that, all for free, we'd do a quick analysis for free by myself. I'll take a look at your portfolio, give you some feedback, and then if you would want to take the feedback and go at it alone, no problem. If you take the feedback and you would like to work with us and you were interested in finding more about what we did, then that would be also okay. But if you really want us to take a look at your portfolio, have an opportunity for me to take a look at the granular depths of it and give you my personal insights on what to do, just drop us a comment in the chat below. Give us a yes, give us your email address. We'll reach out and we'll ask some information, and then I'll create a quick 5 to 10 minute video on what I would do in your situation, and hopefully it'll be beneficial to you. Thanks so much for watching. Hope you enjoyed it, and look forward to giving you lots more property value in future videos.